Bloomberg Audio Studios. Podcasts, radio, news. And Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
A trade team heading over to Switzerland today for trade talks with China. And President Trump out today with a tweet saying 80% China tariff, quote, seems right ahead of the talks. So we'll see how that plays out. Shawn Donnan joins us. He is senior economics writer for Bloomberg News. He's based down in Washington, D.C. Seems right. I don't know. I'm not sure where that number came from here. Shawn, what are expectations going into some of these trade discussions with the Chinese in Switzerland?
Look, the administration from President Trump on down has made very clear they want to do some de-escalation this weekend and that they want to bring tariffs down from the 145% plus level that they're at. We had heard in recent days below 60% was something that they're targeting. The president's out with 80%. But look, the thing to keep in mind here is even if we get what would be a dramatic de-escalation, dramatic reduction from 145% to 80% or 60%, those levels are still incredibly high,
right?
And they're still going to be prohibitive for a lot of trade. And, you know, the folks at Bloomberg Economics have been running the numbers, and you still get plenty of damage to the U.S. economy, to trade, to the Chinese economy. Those are not good numbers. I mean, it speaks to how far we've come in the last month. You know, it was literally a month ago today that these reciprocal tariffs went into place from President Trump, and then he had a bit of a U-turn and put on a 90-day pause. But the window on what is being discussed has shifted remarkably over that time.
Well, and that's what we forget kind of yesterday, too. Like, even though there was a deal with the UK, like those 10% tariffs are still in effect. They're still there. What was so interesting, though, is that he also said that it's up to Besant. Why? Like, what do we make of that? And is that a good or a bad thing as far as markets are concerned?
Well, look, I mean, Besant's the guy for now, right? I mean, he's leading the delegation there, and President Trump has moved around. I mean, a few weeks ago, it was Howard Lutnick who was the guy, right? And on China and other things, it looks like the Secretary of Commerce is now dealing with other countries, and there's a lot of negotiations going on there. Scott Bessent is the man of the moment this weekend. He's being joined by Jameson Greer, who really is the trade wonk in the mission. He's the U.S. Trade representative, of course. So look, you know, one of the things we learned in the first Trump administration is President Trump has lots of emissaries, and he often shifts emissaries over time. So let's see what Scott Bessent comes back with. Let's see what President Trump makes of it, and let's see where the talks go from here.
What's the current thinking, Shawn, about when will consumers feel this? Gene Soroka, who runs the Port of L.A., was in our studio last week, and he said bookings for this week, sailings from China into his port, are down 30 to 35% for this week. When's that going to reach consumers?
Look, it's going to reach consumers soon. I mean, I think, you know, we had new trade numbers out of China today, and exports from China to the U.S. are down by 21%, or were down by 21% in April, and they're only going to get that. You know, they're only going to continue downward from here, even if we get some kind of de-escalation at the weekend. So the one thing that is kind of pushing back against the impact for consumers is that companies have built up a lot of inventories. So you talk to companies and they'll say, we've got 3, maybe 6 months worth of inventory there, and that might get us through. So we're going to see empty shelves, but not all the shelves are likely to be empty this summer.
And then it becomes a question of when do we see those jobs be cut? So if you don't have the volume coming in, do those dock workers get scrapped? And that was a question posed to President Trump yesterday. And he's like, well, good, because the long term it's going to be good for America. But what's that trickle down going to wind up looking like?
Yeah, and we're already seeing job cuts, and you know, we're also seeing hiring slow down. And I think that's the other thing to remember is a lot of the uncertainty around trade isn't necessarily about cutting jobs or closing factories in the short term. It's about not expanding factories.
Right.
It's about not growing. It's about not hiring more people, and that, of course, is what's really toxic for the economy.
Yeah. All right, Shawn, we got to leave it there. Thanks a lot, Shawn Donnan, joining us. He heads up all trade and economic coverage for Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
AI. Well, you remember when the time was we talked about AI nonstop, and then we switched the narrative to tariffs. I kind of want to go back to AI. That seems like a lot more fun. But it's affecting all industries. We know that, including financial services industry. One of our next guests is really involved in that. Josh Pantany, CEO and co-founder of Boosted.ai, joins us here in our Bloomberg Interactive Brokers studio, based in Chicago. In Toronto for our Canadian friends. Welcome, Josh. Appreciate it. Talk to us about Boosted.ai. What do you guys do?
So we make it easy for professional investment managers to build these little sort of AI workers that kind of automate different parts of the process. So you might give it some task related to maybe doing a competitive analysis or tracking what's happening with tariffs, and then have the worker kind of automatically scan through the world and inform you about really important information that could have impacts on your process.
So what's the ROI for something like that? Like if I'm a portfolio manager, what does it look like? What has my job get better, worse?
Yeah, well, it makes your job much better.
I would think that's the selling point.
We kind of think of it in three different ways. We can help automate drudgery. So if you're someone who has to do something like write a deep due diligence document, or if you do a report or a SWOT analysis, or write like a 90-page investment thesis, these are all examples of tasks our system can help you do just a lot faster. The second way we think about it is sort of monitoring the world. If you have a portfolio and you wanted to sort of scan through everything happening in a particular sector, maybe look for every like 8K, 10K, scan through corporate events, the system can inform you real time. And then the last category I think of is sort of like superpowers. A good example of that is when NVIDIA had their Blackwell chip delay. He'd historically analyzed that by looking at sell-side research, talking to IR groups. He'd still do that, but you could use our system to look through like 3,000 companies' earnings calls, summarize across all of them what are the major macro effects of this and how many are still bullish on working with NVIDIA versus other providers. And that kind of analysis just wasn't really possible at scale until our technology came around.
As a former sell-side research analyst, would my job be at risk here? Do people still need me?
Yeah, I think the job's just going to change.
Okay.
I think there's kind of two elements of that work, right? There's the element of producing text, analyzing text, producing numerical analysis. We think AI is going to more or less automate 90 to 95% of that. But there's another deep part of your job where you were going out and actually talking to humans. You were going to conferences, you were talking to management, you were talking to experts. Humans are always going to have a massive competitive advantage. And we think that the job almost gets more humanized. You spend more of your life talking to other people, getting information, learning what matters and keeping the pulse, while the machine keeps track of all the information in the world.
So one of the criticism is that, by going through all those earnings reports or whatever, sell-side reports, you learn stuff. Mm-hmm. And that if you have AI do it, you take away that learning tool. How do you combat that?
Yeah, absolutely. There's still going to be some earnings calls you're going to cover. But there's probably hundreds of earnings calls, maybe up the supply chain, down the supply chain, related to competitors, related to names that you don't cover, that have really big impacts on your stocks that you're probably not looking at today. By adding in something like this, the sort of set of information you can use as part of your analysis just increases a lot more.
Hey, what did you make of the news that's maybe came to a little bit of a head in this past week about AI as a threat to Google search?
Yeah.
What did you make of that?
So, number one, it absolutely is. But I think at the high level, there's kind of two interesting things with AI. Number one, we think we're still very early innings. There's a lot of room to expand. We don't think the market's priced that in. But number two, there is huge disruption that's coming. In particular, we think the cost of producing software is going to reduce like 99% over the next year or two. And so there's a lot of traditional companies that had very strong tech moats where those moats are going to basically evaporate overnight. And we don't think that's been priced in yet.
How are you looking to expand your business? How do you keep growing? I'm sure there's a lot of competition.
Yeah. Long story short, we're just under 1,000 users right now. There's a ton more out there, So we're growing really heavily quarter over quarter. But it's still maybe 1% of the market. And really my mission right now is to capture as much as I can over the next year or two.
So what's the feedback from you go into a hedge fund or something? Are they receptive to it? Do they feel like the quality may not be there? They're unsure about it? What's the reception?
Yeah, oftentimes when we engage, we like to start with sort of asking, what's the task you least like doing? Tell me, you work 80 hours a week, 90 hours a week. What are the 10 hours that you just absolutely do not want to do? And really a lot of that journey is walking them through how to automate that 10 hours, that 20 hours, giving them that time back. And then we kind of build on top of that.
How hard is it to find a team? Like, I'm assuming that competition is huge right now. What's that like?
Like the technology team to actually build it?
Yeah.
Probably very hard. I'm really lucky. I've been in the space since about 2009. Built my first company, first AI company back in 2010 that eventually got sold to Microsoft. Worked in a few
before
other
like
places.
any of us knew what AI was.
Yeah, no, back then it was a bad word. I had trouble raising money in 2009 because no one thought AI was going to be a real thing. Just crazy to think about.
What's like raising money today?
A little bit easier.
Yeah.
No, I mean, this company I've raised about $65 million in that range.
Yeah.
Jump back in time, Maluba, we raised maybe 13 million. So very different fundraising environment.
Do you go to different tools? So how do you keep refining your tools to broaden and make it even more useful? And also the accuracy level, how do you track that?
Yeah. So kind of two different questions there. I'll start with maybe taking track of technology. So we start by having a very deep empathy of understanding what are the kinds of workflows our users want us to automate? What are the kinds of things that actually matter? And then constantly tracking what does success look like for those kind of workflows, and where we have success with that. And I'm sorry, remind me the second question?
The second question was really brilliant. Changing the tool. Accuracy.
Oh, and accuracy. Yes. This is actually really, really vital inside of finance. So the biggest problem is like you're not going to make a $100 million trade if you don't absolutely trust the information that's coming out of the system. So we really think about that in two ways. Number one, we have to have the most accurate system in the space. Number two, we have to have the most auditable system in the space. When the system actually makes a recommendation to you, it's not enough to just give you an answer. It has to give you a very detailed explanation of where it came to that conclusion from, where it came from, and that's something we excel at.
Josh, thanks so much for coming in the studio. Josh Pentany, he's the CEO and co-founder of Boosted AI, company based in Toronto, have an operation here in New York City, showing once again how we're very friendly. The U.S. and Canada, we love these guys.
I mean, yeah.
I know. So
I don't know if that feeling's going to stay, but sure.
No, it's all good. It's all good. We're all friends.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's go down to Washington, D.C. We've got a lot going on there. Henrietta Treyz joins us. She's a managing partner and director of economic policy at Veda Partners. She lives in Louisiana. How cool is that? I think New Orleans. That's awesome. Hey, Henrietta, I mean, from your perspective, and you talk to your sources in Washington, should we expect anything coming out of Switzerland this weekend as it relates to U.S.-China trade?
Yeah, it's a good question. Obviously, the president outkicked his coverage here with the 145% tariffs on China. The problem is 80%, which he's talking about now on Truth Social, is still prohibitively high and doesn't really move the needle for small businesses or anybody importing from China or overseas right now. So the expectation I had going into this before the president started tweeting this morning was effectively that Secretary Bessent is trying to establish himself with the vice premier of China at these meetings in Switzerland this weekend. Historically, what we know from China and what we've gotten from MOFCOM in the last couple of days is that they are extraordinarily cautious and not at all optimistic about whether Secretary Bessent is able to speak for the president, whether the United States is serious about actually reducing tariffs. And so the president is trying to, give Secretary Bessent effectively the permission structure that China needs to enter into the conversation in any kind of meaningful way.
So so did he do it by saying 80% looks good and it's all up to Scott? Was he able to accomplish that?
I think that from a directional standpoint, it's pretty clear now that Secretary Bessent does have this authority to go to 80%. Whether he has the ability to go further than that, I think, is not something that China can necessarily accept, because obviously the president through this tweet is the one who actually set the terms of what's going to happen, not Secretary Bessent. So it does undermine the secretary a little bit. And I think what we should hope at best case scenario is some sort of joint statement, which we don't often get. Usually the U.S. will put out a statement and China will put out another statement, sometimes hours or even days afterwards. And they're very short, they're very curt, and they effectively say, we met. And that's sort of the best that we can hope for going into this before the president tweeted about it. I think that what we'll see now is the business community come out and say, hey, 80% is still too high. We need this to come much, much lower, if not all the way off, which the president does not seem inclined to do.
This trade policy that President Trump is deploying, how is that good politics?
I think the supporters of President Trump really like the tariffs. They like the sort of sticking it to the man mentality. And so even though you're seeing the polling drop pretty materially, even with Republican voters, his core base, I think the last time I saw numbers, it was like 43, 47% of the Republican conference is very supportive of the president's tariffs and his strategy. And they're willing to give him this opportunity to wait and see. But on Capitol Hill, you have absolute panic. It's sort of like ducks sitting on top of the water and then furiously paddling underneath. The Republican Party trying to write this tax bill is running into the reality that tariffs do not raise $2 trillion if they do not bring in revenue. And of course, if you stopped imports, you're not bringing in tariff revenue. So there's a lot of panic on Capitol Hill.
So clearly, though, the narrative is trying to be shifted to lower taxes, I guess, as long as you're making under $5 million as a couple, and also deregulation. Like that desperately seems to be the narrative that needs to be shifted for the administration. Is that happening? Like, is that legit?
Well, that's interesting. The one thing I'd touch on with this $2.5 million for individuals and $5 million for couples filing jointly, this new tax policy for the president, is that, he's the ultimate salesman, right? And he recognizes that this tax bill has a serious image problem. And the image is one that the American public is really primed to notice, which is cuts to Medicaid. We have been talking about Medicaid cuts for 20 years now, since Obamacare. It's something we talk about on our Wednesday webcasts. I wish we could move on from it, but the American public is so attuned to any cuts to Medicaid that they sort of viscerally react negatively to any tax bill that would include those data sets. So in this circumstance, the president has realized that supporting taxes on the wealthy is actually very popular. And this is a great way to sort of reimagine the tax bill and potentially get more support for the package from the American public. But obviously the Republicans on Capitol Hill do not like that idea.
All right, Henrietta, thank you so much for joining us. Appreciate your time. Always, Henrietta Treyz, Managing Partner and Director of Economic Policy at Veda Partners, coming to us via New Orleans, via that Zoom thing here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get to some of the earnings that came out over the last 12 hours in terms of technology. And one of them is a CrowdStrike. So the U.S. is now probing a role of CrowdStrike bosses in a Carahsoft deal. I don't really know what that means, so let's get to that. But it wasn't good for CrowdSource. Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, joins us now. So what's the latest with this thing?
Well, so I think this goes back a couple of months. In fact, Carahsoft is a reseller of software, so they sell all kinds of software to government agencies. And in this case, the contract is like $32 million. That was the end customer's IRS. And it seems the product was never deployed. So even though it was accounted for in CrowdStrike earnings.
Oh, I think I remember this, yes. Mm-hmm.
So it's getting probed, but to my mind, for a company like CrowdStrike with a $4 billion revenue run rate, they have federal exposure, but it's like maybe mid to high single digits, so not a whole lot of government exposure. And it is more of a one-off. I can't imagine, that being a problem with how they do the accounting. It is more about how they source the contract through this reseller, Carahsoft. And when did it show up in the income statement as revenue? So nothing, to my best of my knowledge, is accounting related. It's more about the sourcing. And we have seen that with other companies like ServiceNow in the past where, you have government agencies that award contracts, and these are lumpy. Like think of them as 12 months in the making, and then suddenly you get awarded a big contract. But nothing really that affects overall companies' sort of sourcing of contracts, I think.
Got some competition in the card hailing business. Look at Lyft, up 21%
it's
today.
Like, forget CrowdStrike. Let's not forget about
CrowdStrike.
Yeah.
I mean, again, Lyft, I bet you over the last 10 rides I've done, I've probably taken Lyft 7 times because they just had the better pricing and materially better pricing.
Yeah.
So somebody's algorithm's not working, either Uber's or Lyft's, but I'm taking advantage. I'm arbitraging that bad boy.
Yeah.
What'd you learn from Lyft?
Well, that pricing is the thing to focus on.
Yeah,
if you have lower prices, that helps you get repeat customers. And I think that what you just said absolutely makes sense. And look, when you compare Lyft to, let's say, DoorDash or Uber, Lyft has got about 24 million monthly active users. DoorDash has 42 million, and Uber's is much higher because they have geographic diversification. But when I compare the overall rides, Lyft does less than 1 billion rides in a year. DoorDash does 3 billion orders with 42 million users. So that just goes to show there is a lot of room for Lyft to increase frequency, and people are price sensitive. So that's where
is that the only thing that you can different? Am I like the person? Again, me, it's just price because I know it is in most cases the same car, the same driver.
Yeah, and they have tiered, the customers. So if you want to go for a higher end service, they have vehicles available. So from that perspective, there is not much differentiation between an Uber and a Lyft.
See, I think I'm gaming the system here. Very
totally, and you told everyone now, so now you're going to drive up prices for everything. But what did Lyft do to manage their costs to help their margins, is considering that their market share, say, didn't grow?
I mean, look, in all fairness, the valuation was less than 1x sales. So you compare it to other marketplaces, DoorDash trades at 5x EV to sales, Uber is more 4x EV to sales. So Lyft, a lot of the bad news was priced in that this company is losing share, they would never really be profitable. And they just managed to execute much better operationally. They've been cutting costs on the operation side, sales and marketing side, and they have limited their ambitions to those 25 million monthly active users. They're not going after 100 million what Uber has. They're saying, if I keep getting repeat business from this 25 million, that will help me sustain mid to high teens growth. I don't have to go for user acquisition right now. And look, they are making an acquisition in Europe now, free now, so they are looking to expand geographically. But it's really finding your sweet spot and niches where Uber is not that big. And that strategy is good enough because at the end of the day, it's still a duopoly in ride sharing.
I recognized when I was down at Duke a few weeks ago, when I was a student there, parking was impossible. Now it's not a problem because not as many kids bring their cars because they just rely on Uber.
Yeah, makes sense.
So it's like
you don't have to worry about
So it's
driving
like
drunk or anything.
They were telling me it's not an issue anymore. So how about that? All right, Mandeep Singh, thank you so much. Appreciate that. Senior tech analyst for Bloomberg Intelligence.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.